The stock market hasn't had a steeper correction, perhaps, so will that remain the case? Let's welcome in Mark Okada. He's the co-founder and CEO of Sycamore Tree Capital Partners here at Post 9. It's good to see you again. Welcome back.
Thank you.
I mean, those are the markets you watch more than the equity markets. And credit's behaved okay, right?
Sure, it's been all right, but it's starting. We're starting to see some
spreads are widening a little bit.
Yeah, a little bit.
You concerned?
I think it makes sense that the uncertainty that is rising across geopolitical, economic, consumer markets, rates, Fed, all of this uncertainty has to have a premium to it. There's got to be a risk premium built somewhere. And so we're starting to see that priced into markets a little bit. And frankly, if you're bullish, which we still are, which is kind of weird, but we're still bullish.
I don't know. Your voice sounds like it's wavering a little bit on that view.
I hope it does, because that's how I feel. I'm certainly not as risk on as we felt maybe 6 months ago. But I think that the idea that markets need to move and put a higher risk premium, given the uncertainty, is rational. And so I feel good about it because we're still ramping, we're still buying credit. And if you can buy it at a better price because there's more spread in it, that's always a good thing per se. We're not seeing it show up in the fundamentals yet, Scott. The defaults are actually down. So boring is back, right? In the equity markets, credit's kind of a boring place per se. I mean, we don't react as much to have to. The fundamentals don't move with tariffs and all of this other stuff. But that being said, I mean, these markets have been moving a lot.
Yeah. I mean, they've been volatile. But you said, you're not as bullish as you were 6 months ago when this was supposed to be risk on. Yeah. Right? Yeah. What's happening?
Well, I think Trump has come in untethered, and I do believe that he has assessed that his time, right, is not long, and so. Let's say they lose Congress in the midterms, right? And his ability to get a lot more done kind of goes away in that scenario. So get it all done now, push as much out as possible,
including a lot of the messy stuff.
Yeah, the uncomfortable things. But on the other hand, right, we had proof today of what markets do. I think Trump probably only listens to the markets. He certainly doesn't listen to anything else, but he listens to the markets. So what happens, right? The markets sell off. We lose the whole Trump bump. And, okay, we're not going to do the tariffs on cars with these guys, right? We're going to moderate our policy. And we see this bump today. So I think as we think about credit, where I would see the canary in the coal mine and the thing that I would be watching if I were, an investor at home, I'd look at probably the IG market. It's a much bigger market. It's pretty high and tight. It's run well, but that spread there, when it starts to move, and if it moved, it's up 5 basis points on this kind of stuff, which is not much, but if it goes out 10, 15, 20 basis points, I'd start to think really seriously about some defense.
Are you worried about corporate confidence eroding further, and that's why you're watching that particular market as closely as you are?
I think corporate confidence is definitely down, and it should be. We're seeing earnings revisions down significantly. Mm-hmm. I mean, we talked about this risk-on period. It was supposed to be really risk-on, but you had almost 17% earnings growth in the fourth quarter. Projection was for 13 this year. We're down to 10, 11, maybe 10, 9. I don't know. It's come down a lot in 2 months. So you're right. I mean, that confidence that a CFO, a CEO has about how they're going to run their company is definitely a problem. And it's also, when you think about the Fed, what is the Fed's reaction to all of this? I mean, the Fed's in a difficult spot because they've got things that are going both directions on them, right? I mean, employment is definitely an issue. I mean, I think if Doge is supposed to do something about the deficit, it's an ice cube at a volcano. The Doge doesn't. There's only 4.5% of the budget that's people, that's salaries, right? So Doge doesn't affect the overall sort of deficit, which is really the issue. But it does hit confidence. It does hit payrolls. It's going to hit one of the things that the Fed really cares about. And so we'll see what happens on Friday with the employment report. So that would kind of, and the market's pricing in 3 cuts now. So maybe that's what people are thinking. But on the other hand, all this tariff stuff is stagflationary. That's not good. That goes the other way on their mandate. So I think they're sitting on their hands right now. And if that's the case, and you're a CEO, you don't know which way the Fed's going to move, that makes it even more uncertain. So yeah, it's difficult.